Hello and welcome to this week's weekly market update here at Think Markets. My name is Alejandro Zambrano, and in the next 10 minutes or so, I will provide you guys with an update on the key developments of last week and also talk a bit about what may happen in the next 5 days in the world of trading. But before we start, as always, I need to stress that trading financial markets unfortunately is high risk, and there's a risk that we'll lose all of our invested money. If you're watching the recorded version, you're most welcome to pause and just read this. Okay, good. Let's talk a bit about what happened last week, because that sets the tone for this week. So we had durable goods orders. That is just an indicator telling us how much people are spending on things like refrigerators, cars, even aircrafts, and military spending. And if you look at the number, durable goods orders increased by 9.9%, which was much higher than the 4% expected and much better than the negative 6.7 seen in last month. Now, this is important, especially for things like dollar yen. Remember, dollar yen dropped sharply in the beginning of last month because the unemployment figures were bad and people said we were heading into a recession as well. The Bank of Japan raised interest rates, and that surprised people. Now, the US economy doing slightly better than expected should have a positive impact on something like dollar yen, potentially lifting that, something we're going to discuss in the next minute or two. From Australia, we had inflation figures. They were slightly lower than expected, but still quite high. That can, of course, cause the Australian Central Bank to be more hawkish compared with something like, for example, the ECB and the BOJ, given that inflation here is a bit too high still for Australian standards. Now, in the US, GDP was stronger than expected at 3% in the second quarter versus 2.8% expected. And this is interesting, jobless claims. So a couple of months ago, we had worsening jobless claims, and that helped to cause that massive sell-off in the dollar yen and in stock indices. But say in the last 3 weeks, jobless claims has been coming in as expected, so we're not seeing that deteriorating. Now we'll still remain in an uptrend. So the labor market is still not doing too good in the US. But the key point here is that it's not as bad as people thought. And that again explains why stock indices are up. And it explains as well why maybe dollar yen needs to trade up a bit. And then we had inflation from Tokyo, higher than expected. In the euro area, inflation was lower than expected at 2.2%. And in places like Germany and France, the inflation figures dropped below the 2% ECB target. That's the first time since August 2021. What does this mean? Well, that means that on September 12th, there's a very high likelihood that the ECB is going to cut rates once more. That will be by 25 basis points. Now, in the US, inflation came in as expected at 2.5%, while core inflation was at 2.6% annually. And that was lower than the 2.7% expected. Now, I would argue that core inflation here is still a bit high. Sorry, this is the headline, and this is cool. But the way things are looking right now, we'll still have a rate cut, most likely by 25 basis points in the September 18th meeting. Now, this is interesting. The market is still giving it, I think last time was about 35% probability that they're going to cut rates by 25 basis points, okay? Sorry, by 50 basis points. And whereas realistically, it looks like we're going to have a 25% basis points. So why am I telling you this? Because this week, on Friday, we have non-farm payrolls. On Tuesday as well, we have ISM manufacturing and ISM services. I would argue if ISM manufacturing slightly stronger than expected, and as well ISM services and the non-farm payrolls, if all of those three are stronger than expected, then it's more likely that we're going to have just a 25 basis points rate cut. That means that people are too bearish on the US dollar. So it could be dollar bullish this week. And I think the better ways of playing this again is something like dollar yen. So as for the data, you have manufacturing figures, as I said, that happens tomorrow at 3 p.m. London time. ISM has been below 50 since December 2022, except April 2024. And these are one of the reasons why people say we're heading into recession now, because ISM manufacturing is contracting. And it literally just means that the manufacturing sector, the people that do produce these durable goods orders, they are contracting, and they've been doing so since December 2022. And you have GameStop earnings. If you remember GameStop, that's something you can trade within markets. And then you have ADP figures, which is like a prelude to the US non-farm payrolls. And then you have jobless claims, ISM services, and non-farm payrolls on Friday. For non-farm payrolls on Friday, 164,000 new jobs are anticipated to be created, which is higher than the 114,000 we saw last month. Also important to note that last month's reading was the lowest since March 2021. And the unemployment rate is expected to improve a bit from 4.3 to 4.2%. So this is the key data for this week. If you look into trade the news or looking for reversals in the markets, you definitely want to put this down in your diary. You got ISM manufacturing on Tuesday. On Thursday at the same time, you got manufacturing services, as ISM services, and then you got non-farm payrolls. So what about the charts? What about the markets then? Well, take a look at this. This is the Euro USD. So a couple of weeks ago, we said a break to 109.64 can lift the price higher, and maybe as high as 111.23. Sorry, 112.23. We grazed that. We came very close to it. Of course, you don't hold the position all the way towards target sometimes, so you should many times just get out before. So I hope you were able to capitalize on this. And on the weekly market update that we publish on thinkmarkets.com every Monday, we said above 110.95 people gonna buy, but you can see the price went down. And if one would have bought maybe at 111.10 or something like that, would have been stopped out for a small loss, which is perfectly fine. It's just the way the market works. Now, it's bearish. And on tradingview.com, I'm publishing short-term updates. But yeah, we're short and bearish. I think we can go a little bit lower, maybe 110. But around 110 all the way down to 109. This is former resistance that blocked the price for most of 2024. And if we can remain above this section, I think we're going to push up again. Now, what would force this to go substantially lower? What's going to force us to go to 108, 107, maybe 106? Well, for that to happen, the US labor market must be much stronger than expected. And in the euro area, inflation needs to come down dramatically. And it doesn't look likely because the unemployment rate in the euro area is at levels we haven't seen since 1995. That's how good the labor market right now is in the euro area. In the US, things are deteriorating, as we already know, with the manufacturing contracting, and things are not looking too good. So realistically, given the macro fundamentals, most likely we'll head up again. And I would be very bullish again from 110 all the way down to 109. But this is something that takes time. It will take a couple of weeks, maybe 1 or 2 weeks for this to potentially bottom out or head higher. Now, this is the dollar yen. And the dollar yen, as you know, has been trading lower. And a break to 146.57 would probably mark the end of this downtrend. We have been saying to be bullish between 143.71 and 140.17, and the break to 146.57 will probably confirm that. It's not going to be clean, it's not going to be easy, but probably break the upside and then down, and then maybe up to 152 in the next couple of weeks. At least the US data is supporting that view. As for crude oil prices, the prices are in a downtrend. We've been saying be bearish below here. Worked out fine, and then we said bearish around the same levels for it to go down, and that would also fine. But it's not an easy market to trade. I wouldn't touch it. For now, I'm bearish below 80.65, and sort of around Friday's high all the way up to this level, I'll be bearish, assuming we're going to go down to 76. Now here are gold prices. So gold prices have taken a break. Why? Well, because US data has stabilized and the inflation is what's coming down in places like the US and also Euro area. And we know that people buy gold because they're afraid of inflation, or they think the world economy is going to collapse, or we have war, right? All those three things. Except the war situation and the tensions in the Middle East, the two former ones, the risk of that has diminished, and that's why prices are flat. However, we're still working with this ascending triangle pattern that we identified a couple of weeks ago. At that point, we said a break here can take you up here to 2,579. I'll stick with that view as long as trade above 2,446. And here is the S&P 500, which is trading sideways, and a break to 5,654 could potentially lift this above the old all-time high and or the current all-time high, and potentially push things upwards. There are two ways of trading this. One is either buying a dip down here. The alternative is working with a breakout whenever that happens. And here are Bitcoin crypto prices. Unfortunately, they just reverted back into their sideways trading pattern. If you draw a line here, you can see that we're sort of stuck in a big corrective phase. There's not too much to do with this right now, just waiting. Break to maybe this level at 65,260 could potentially be beginning of something, but I wouldn't get too excited. This has been trading sideways for a while, and if you trade altcoins, then you know that we are in the multi-year bear market in altcoins. There's no even point of warning around now because it's already come back down massively. Like in altcoins, some of altcoins have given back like pretty much all of their 2024 gains, and it's been like this for some time. And people said, all right, we're back at 2024 lows, so let's buy. Let's see if we can push this to the upside. But that hasn't happened. The market continues to be weak. So with that in mind, we're going to wrap things up. Thanks so much for watching. We'll be back around the same time next week, which is 9:30 London time. Just log in here. You'll get the notifications when we go live. But yeah, between sort of 9:30 London time, that's when we do this market update. Thanks so much for watching. If you have any questions, say you're watching the recording, just leave them in the comment section, and we'll check in here later and see if we can help you out in any way. Thank you and goodbye.